All right, what's up, tycoons? What's up, traders? Super excited for today's video. All right, we're going to cover natural gas. All right, we're going to take a look at BOIL and UNG and break things down. I'm going to do a little bit of a different style video today. Make sure to smash that like button, subscribe to the channel. I'm covering natural gas every single week. So if you're looking for a channel to get some updates regularly on natural gas, this will be a good channel for you. Now, hopes for a rebound in natural gas are looking grim, right? We have wild swings in natural gas prices caused by the Russia-Ukraine war. Those continue to attract speculative bets on the commodity. And, we're witnessing the classic symptoms indicating that retail traders are suffering from the illusion of value. Now, there are tons of retail traders that are suffering right now. Okay. I've had lots of Zoom calls and one-on-one sessions with many people down significant amounts, whether it's, 4, 5, 6, even 7 figures, in Boyle on particular. So, I just wanted to make this video to, give you guys a different perspective. Okay. I don't want to always come off like it's super bullish, right? I try to come off unbiased. But this video is going to be a little bit more eye-opening, right? Now, the fundamentals, right, suggest that the meteoric surge in natural gas prices in 2022 is unlikely to repeat without the same severe disruption to supply. So, we would need some other type of major catalyst to really get an insane spike on Boyle, right? When it comes to, some people think Boyle is going to go back to 100, right? We would have to see natural gas prices go up extremely, extremely high, right? The perverse dynamic of shale oil production means high oil prices are indirectly placing downward pressure on natural gas prices. And, you know, I do hold some natural gas. Okay, I hold UNG shares, but I have puts, which are options. Okay, betting that Boyle is going to go down. So I'm making money on my puts on Boyle. I've taken profit on those like 2 or 3 times, and then get back in on the pops, and then I just slowly accumulate some UNG over the long term. Right. And, just my shares are green today. If we take a look, right, we do have a nice pop here in natural gas. This is Boyle up about 14% in the past week. UNG is up 8.67%, and natural gas futures are up about 6% here. So, we have seen a nice move. Okay. But, of course, this video is not going to be financial advice. I'm not telling you guys what to do. I am just telling you, what I'm doing currently, and then I'm going to go and break down Boyle and, the situation behind natural gas. So, any investments that you guys make, please do your own due diligence, have some type of risk management involved with that. Now, it's been more than a year since the Russia-Ukraine war stoked fears that Europe would spiral into a deep energy crisis, right? But the meteoric surge in natural gas prices, which peaked on August 22nd of 2022, has since witnessed an equally dramatic collapse back to 2020 levels at the time of this writing, right? And so we can see here, we have Boyle in orange, right? And we have natural gas futures here in blue. Right. And we had, this huge, insane spike. This is 22 right here. Huge, insane spike, right? Then a sharp sell off, and then an even bigger spike, right? And actually put in a new high. But take a look what Boyle did, right? Boyle actually did not put in new highs when the natural gas futures did. Okay. And there's a couple reasons for that we'll go into. And things have really just been looking rough for Boyle here lately. Ever since that peak, it's just been a insanely dramatic drop to the downside. Now, unsurprisingly, the extreme volatility in natural gas prices has attracted the attention of speculators, right? In hopes for a rebound might explain the sharp increase in web searches for Boyle ETF and UNG ETF, which refers to the natural gas ETF as well as, the Boyle ETF, right? And so, as the accompanying charts show, worldwide web searches for Boyle and UNG have increased in recent months, according to data from Google Trends. And, this is Google Trends here, and we can see the insane spike, right, in Boyle ETF and people searching for the Boyle ETF. We see a massive increase right here in the UNG ETF. Now, it has died off here, and that's because, in my opinion, a lot of people are seeing that natural gas prices still really haven't recovered. Maybe they've lost some money, and so they're not really interested into things so more. But there is consensus among Seeking Alpha analysts that the outlook for these ETFs is generally bullish. At the time of the writing, Seeking Alpha analysts have an overall buy rating on both of the ETFs. But Seeking Alpha's proprietary quant rating model, however, is much more pessimistic and assigns a strong sell rating for both ETFs. So let's dive into things a little bit more, all right, and then talk about misplaced hopes and the illusion of value. A casual review of recent articles published in the financial media, as well as an anecdotal evidence from discussions and trading forums, suggests that speculative hopes of a rebound in natural gas have been building up in recent months. Not surprised by the growing interest among retail traders looking to take bullish positions on natural gas, mainly through exchange traded derivatives or natural gas ETFs such as BOIL or UNG. But what's surprising is the sheer lack of fundamental reasons and logic supporting the bullish thesis. The vast majority of bullish arguments offered were based on a potential escalation in geopolitical tensions with Russia, extreme winter conditions, and the typical because natural gas prices have fallen too far. Now, whenever I've talked to people, that's pretty much the one that everyone has told me, right? Natural gas prices have just fallen too far. Now, I did a whole video on, when you look at the spot price of natural gas, historically, buying under $2 has been, a good buying opportunity, but it's taken at least 3 months, and sometimes it takes up to a whole year for prices to really recover and get above that $2 level and see a nice spike back up to two, or from two and below two to about $3 or $4 on the spot price of natural gas. Okay. Now that history doesn't have to repeat itself, but when you go back and look at the charts, and I've got entire videos dedicated to that and going back and showing you guys, how long does natural gas really, consolidate around that $2 price range, and how long does it stay below there? It's a really good in detailed video, but what we're witnessing is the classic symptoms indicating that one is suffering from the illusion of value. Retail traders are mistaking low prices for value, and that seems to have been disillusioned by the magnitude of the recent swings in natural gas prices. They seem to believe that all they need to do is wait for prices to swing up again, just like they always did before. Surely, catching prices at current lows means that there is a margin of safety to shield them from outsized losses, right? Well, price and value are different things. Undoing the confusion that arises from trying to understand the difference between price and value is fundamental to successful investing. Investors would often prefer to jump straight into trading strategy or analyst ratings without having to read philosophical writings on value. So this section is specifically dedicated to readers who are keen to learn more about the philosophy on the topic. The concept of value may be better understood by comparing commodity trading with investing in equities. Value investing is naturally more compatible with investing in equities, while short-term trading of price action tends to be more compatible with commodities. We're not necessarily condemning all commodity traders to be short-sighted day traders, but merely making the general point that it's more natural to invest in equities and then trade commodities. One reason why investing differs from trading is that time tends to favor the former, but rarely the latter. For equity investors, the buy and hold strategy itself is a winning strategy with positive expectancy, due in part to the natural tendency for equities to drift higher over time. This tendency to drift higher is due to several factors, including corporations being a productive asset, productivity growth, in general over time, the rising share of corporate profits versus labor income, and inflation. Thus, when one is investing in the equity of a business, one should be investing with the expectation that the business will continue to add value for shareholders over time. Most commodities, on the other hand, are usually regarded as an economic resource. Thus, the spot price of a commodity is usually determined solely by short-term demand and supply, and there is limited scope in adding to the value of a commodity itself. More often than not, technological innovation and improvements in productivity over time actually result in less of a commodity being used in the production of a final good. The rewards of innovation also go towards increasing the profitability of corporations that invested in research and development rather than directly increasing the perceived value of a commodity by the broader market. This is because innovation typically occurs at the corporate level and not at the point at which a commodity is extracted. Finally, the production and supply of a commodity itself can be adjusted to match market demand. And we see OPEC, messing with things like this, right? Talking about, cutting oil production and different things like that. Commodity producers constantly try to weak production levels by investing to increase production when demand is strong and prices are high, and by curtailing production when there is excess supply and prices are low. Holding onto a commodity over time simply doesn't add value to it unless there is some constraint to supply over an extended period of time that would result in a persistent demand-supply gap. Only under such special circumstances can one argue that prices are not reflecting the realities of that demand-supply gap and that a commodity may be undervalued. To be clear, price and value are different things, and the price of a commodity can certainly fluctuate as a result of speculative demand. When the market deems or bets that the future price of a commodity will rise, then future prices will adjust to reflect that expectation. The problem with price, however, is that it is often fickle and challenging to predict with accuracy. Value, on the other hand, forces prices to reflect the underlying demand and supply of a market over time. Although prices may occasionally stray from value as a result of speculation, prices eventually adjust in response to underlying economic forces. So really quick, UNG and boil and cold and things like that, that's not the only way to invest in natural gas, right? I actually have a video going over the top 10 natural gas companies as well as the top 5 liquefied natural gas companies, right? So there are actually companies, right, that are, making profit and, looking to provide that value and increase the value that they provide to the shareholders. And maybe perhaps that's one thing that you would rather invest in maybe than just actual natural gas ETFs itself, right? Again, not financial advice, not a recommendation or anything like that, but something for you to consider, right? Is that, there are other possibilities and, those stocks, right, and those companies, the price of their stocks, performs much differently than Boyle would, right? And it's not always going to perform the same, but you can look into those a little bit more, or maybe you can watch, some of those videos that I just mentioned I made, and get a different idea on some of the different companies that are out there that use natural gas or supply, produce natural gas, different things like that. Okay. Now, waiting for a rebound, right, could be very costly. Patience is often a prerequisite for successful value investing, simply because great business plans and value creation could take several years to materialize in the form of actual earnings. However, for speculators holding onto a bullish position on natural gas, the cost could really add up over time. As the accompanying chart demonstrates, the price of oil tends to decline over time. This is partly due to the cumulative effects of contango. In the futures market, contango refers to when the price of futures contracts that expire further in time is higher than the price of contracts with a closer expiration. So, if you don't understand what that means, all right, basically Boyle and UNG, the way that they're calculated, all right, is they're based off of futures contracts, right? And so, the way futures works is the contracts, the further out in expiration you go, the more expensive the contract is. Now, rather than fulfilling the contract, okay, and exercising the futures contract, what they do is they sell that futures contract, that is, expiring in a short amount of time, and then they buy another futures contract that's further out in time, right? And so I just explained to you guys, the contracts are cheaper when they're closer to expiration because they're more closely correlated to the actual price of the natural gas versus the contracts in the future, right, that are farther out in expiration. Those are always more expensive. So essentially what's happening is they're buying high and selling low, rinsing and repeating that process of buying higher future contracts at a higher price and then selling them at a lower price, right? And so if you take a look here at the natural gas futures versus Boyle, you can see, the dramatic difference in the prices, right? Now, yes, there are spikes in Boyle when natural gas futures are going up, right? But look here where it makes highs and then a higher high, and then Boyle makes a high and then a lower high. Well, the reason was because of that decay factor, right? Not only is there contango, but there's lots of decay and myths associated with Boyle and UNG as well. I have a really great entire video dedicated to that subject, diving into all of the different types of decay associated with those. That's definitely worth a watch. All you have to do is type in UNG Boyle decay, Zackley trades, and it'll pop right up. But due to Boyle having to constantly switch out nearer futures contracts for contracts that are further away from expiration in order to maintain a leveraged long position on natural gas, the cost of switching contracts adds up over time when the market is in contango. Furthermore, because tracking near-term natural gas prices means holding futures contracts with a short window to expiration, transaction costs also add up quickly just to roll the position over time. Expectedly, the expense ratio for Boyle is also much higher compared to regular unleveraged ETFs at 0.95%. This characteristic of the futures market presents a difficult challenge for traders that the Boyle is an effective tool to trade natural gas only in the short term, but is destined to become a losing trade the longer one extends it, right? So fundamentals right now are consistent with lower prices. although, don't completely dismiss the possibility that natural gas prices could rebound from current levels simply because the commodity may be oversold from a technical standpoint. The lack of fundamentals supporting a bullish view means we see little reason to take on risks. Besides, the fundamentals for natural gas are actually looking quite grim. A recent article published by Reuters provides a good explanation of why natural gas production in the U.S. has not been cut despite the recent plunge in prices. In short, the excess supply and buildup of natural gas and storage is predominantly due to natural gas being produced as a byproduct of shale oil production. Because oil prices have remained elevated and are at profitable levels for shale oil producers, production has expanded in the Permian Basin. This has resulted in more shale gas being produced and stored despite lower prices. This perverse dynamic of shale oil production means high oil prices are indirectly placing downward pressure on natural gas prices. So, as long as oil prices remain at levels that are profitable for shale oil producers, the excess production of shale gas is unlikely to cease. For natural gas prices to rebound, it seems the market would need to bet on colder winters and a booming economy, both of which are currently not within the scope of even the more bullish analysts around. So that kind of just sums up today's video, guys. Hopefully you enjoyed it. It's a little bit different than the normal natural gas videos I do. And, I just wanted to provide some really good info there and, tell you what maybe other people aren't telling you, right? Just because something is low, and has fallen dramatically, right, doesn't, it can present that illusion of value, right? And we talked about that in this video. And I don't want you guys to get caught up into the illusion of value and just keep throwing more money into the fire pit, right? And watching your money burn away, rather than having a plan, right? Now, as I mentioned, yes, I am long natural gas and shares. Of UNG, but I have put options on Boyle, right? And those put options have seen plenty of profit, and they've had plenty of times where I've been able to take profit, on those, and that's making up for any losses that I have in UNG, right? So essentially, with the puts, right, I can take the profit from there, and the money that I've made from there has, made up for any type of losses in UNG, and really, been through trading Boyle, right? The shares that I own for UNG, in a sense, are kind of free, right? It's really just from profit from some of the other trades that I've made, whether they're related to Boyle or other things. So, it's not like I'm throwing new capital into these things, but, rather just having a plan, having a specific plan, having some downside protection, in case things do continue to go lower, right? And if they don't and things go higher, then, I'll be able to sell those shares for a profit. And if not, well, at least I had a plan that works for me. So it's best for you guys to come up with a plan that works for you and actually stick to your plan. I've mentioned, I do these coaching calls and one-on-one sessions via Zoom. You guys can feel free to email me at exactlytrades@gmail.com. And, there's been many people, not all, but there's been a few people who were just short-term trading Boyle, right? And then what happened was one day they woke up and Boyle gapped down, right? And it was just down massive. And they were like, okay, well, let me buy this dip and I'll sell it the next time it pops, right? And then a week or two or three or four go by and they look back at their position and it's just plummeted even more. So they're like, oh, well, now I really got to buy the dip, right? Because I got to make back all this money that I just lost. So let me put even more money into it, right? And then, maybe Boyle pops for a day or two, or it has a good week or two, and then things go right back down. And instead of selling when, things were popping and maybe cutting their losses, they just keep continuing to hold, right? And so I don't want that to happen to you guys. If you have some type of a plan where you're like, hey, I'm going to buy here, and if it goes to this price, I'm either going to cut my position and, have a stop loss, or maybe I'm going to have some type of a hedge, right? Maybe through options, maybe through, there's many different ways to hedge yourself. Okay. You can, go long on cold, many, many different ways. But, as long as you have a plan and you know what you're willing to lose, right, before you even buy a position, and then you stick to that plan and stick to that script, right? If it dips below your stop loss, make sure you execute that stop loss. Okay. Don't just have it there for no reason. And then, make a new stop loss below that, and then make a new stop loss below that. you know, and, you know, just accept the fact of, hey, you know, this trade is either going to work or it's not, right? There's only two outcomes that are going to happen. And as long as you are happy with both the outcomes and you have a plan of, okay, well, if, you know, Boyle or UNG goes to this price, right? I want to sell for a profit at this price. Even if it goes up past that price, I'm not going to be mad because I followed my plan and I bought here and I sold where I wanted to. And if it goes below a certain price, you know, I'm going to sell there as well and cut my losses and maybe move on to something else, right? So again, that's it for today's video. Smash that like button, subscribe to the channel if you guys are new. Feel free to shoot me an email. Okay, we can try to work on setting up a session, and I'm out.